folks, Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. And things look nice. S&P 500 currently at 4725. That is it's up about 23.5% year to date, about 75 points off of the all-time high for the S&P 500, which is 48, right at 4,800. And I would note that the 10-year Treasury rate has dropped actually below 4%. So we are down about 1% on that versus the highs, which was just about a month and a half ago, a few short days, and how the market and the narrative has changed. All of this most recent rally set off by Fed speak on Wednesday, the Fed basically coming forward and saying, changing a little bit of the language within their press release to reflect the fact that they say that we believe we are at or near the peak of interest rate hiking for this cycle. So that helps investors to believe that maybe there's not a future rate increase on the table. And then secondarily, I think the most important thing to come out of yesterday's various pieces of information was that Powell said that the Fed will start to lower rates before they actually get to the 2% inflation target. So that removes a little bit of headwind from the market in terms of how the Fed is thinking about all of this. They will be willing to start to go ahead and lower rates as we see inflation get down more in the 2.5% range. You don't have to get all the way to 2 before you're going to see rate cuts. The Fed very clearly indicating that there is a lag to monetary policy, and they want to be aware of that. If you wait until it hits 2% before you start to lower those rates, you may have waited too long. That is the best Fed day ever, Fed day being a day in which the Fed speaks to the market or makes a rate decision. Best Fed day across all asset classes in about 15 years. Set off yesterday as Wall Street just sort of cheered this notion of, hey, we're done with raising rates this cycle, and the next thing that you're going to hear out of us is going to be a cut. I would note that there's a little bit of a disconnect between the Fed and Wall Street as to how much of a cut and when that might happen. The dot plot for the Fed, or what the Fed would sort of guide you to, is, hey, we're probably going to cut rates 3 times next year, maybe starting in June. If you look at some of the more aggressive Wall Street models out there, they're looking for more like 6 rate cuts next year, starting in more like March. So a little bit of a disconnect there. The market believes that the Fed will be able to come off faster than the Fed is indicating. I would just note that those are all very highly unpredictable events because they depend a lot on what's going on in the underlying economy. And I will just caution to beware of the second derivative. This is something that we talk about a lot. First derivative is, are we growing or are we slowing? Are we growing or are we receding? Second derivative is, what is the pace of that growth or recession? I think it's just important to note, in the past 45 days, we've seen asset prices rally substantially. We've seen consumer confidence kind of reverse course as the stock market improves. We've seen, record Black Friday spending. And we've seen long-term interest rates drop by a full percentage point, which is all huge and all kind of stimulative. So this is something that we've talked about before several months ago, how when you start to indicate that rates may come down, you get these movements in long-term rates, which stimulate the economy without the Fed even having to change the short-term rate. Yet to be seen whether or not that stimulus might actually reignite a little bit of inflation and or slow down the path with which inflation is declining. But just something to note that, we haven't yet seen, all of this is stimulative. We haven't really seen the impact of that stimulation on labor markets or the overall economy. And so we may not technically be out of the woods yet, but at least good to know that if we aren't out of the woods, that the probable path here is that the Fed is just going to leave rates where they are for longer than anticipated, as opposed to maybe feeling the need to bump up. So that's very good. I would also just note, just as a kind of humorous aside, we always preach diversification, when we talk to folks, because you never really know. I would just note that, the S&P 500 is very, very close to its all-time high at 4,800. And the Dow Jones actually set a record high yesterday. It is back above its peak that it set back at the beginning of 2022. So it is fully cycled in about the 22-month time frame. And meanwhile, the NASDAQ is about 8% below its peak, that it set back around that same time frame, which is kind of interesting to me. NASDAQ has been all the rage this year. There are a lot of folks that, are constantly pumping the Magnificent Seven, these 7 NASDAQ tech stocks that have just had phenomenal years this year. I feel like it's important to kind of remind people that if you've held them for 2 years, you're actually a little bit worse off than where you would have been if you just held the Dow Jones Industrial, which has been, not the greatest performers of this year. So with that, I just want to say that this will probably be the last market update for the year. And if I don't talk to you again, I wanted to wish everybody a very, very happy holiday season and a fantastic new year. As always, if you have any questions, please feel free to reach out to myself or your advisor, and we look forward to talking to you in 2024.